Archegos, how one man lost $20 billion in 2 days. In the gleaming towers of Manhattan's financial district, where fortunes are made and lost with the click of a mouse, there existed a secretive investment firm that most people had never heard of. Archegos Capital Management operated from a modest office space, employing fewer than 50 people, managing what appeared to be a relatively small portfolio of around $10 billion. But appearances in finance are often deceiving, and behind this unassuming facade lay one of the most spectacular financial disasters in modern history. In just 2 days, in March 2021, Archegos would lose over $20 billion, trigger a global banking crisis, and ultimately contribute to the downfall of one of Switzerland's oldest and most prestigious banks, Credit Suisse. This is the story of how one man's unchecked ambition and Wall Street's insatiable appetite for profit created a financial weapon of mass destruction. The man at the center of this catastrophe was Bill Hwang, a soft-spoken former hedge fund manager who had already tangled with regulators once before. Born Sungkook Hwang in South Korea, he immigrated to the United States as a child and eventually made his way to Wall Street, where he worked at prestigious firms including Peregrine Investments and later Tiger Management, under the legendary Julian Robertson. In 2001, Hwang struck out on his own, founding Tiger Asia Management, a hedge fund that focused primarily on Asian markets. For over a decade, Tiger Asia generated impressive returns, managing billions in assets and establishing Hwang as a respected figure in the Asian investment community. However, his reputation took a severe hit in 2012 when Tiger Asia was charged by federal prosecutors with wire fraud related to insider trading in Chinese bank stocks. The firm pleaded guilty, paid fines totaling over $60 million, and was banned from managing money for outside investors. Most fund managers would have retired after such a scandal, but Hwang saw this setback as merely a detour rather than a dead end. Rather than disappear from the financial world, Hwang reinvented himself by establishing Archegos Capital Management in 2013 as a family office, a structure that would prove crucial to his eventual downfall. Unlike hedge funds, which manage money for external investors and face strict regulatory oversight, family offices manage wealth for a single family or individual and operate with far less scrutiny from regulators. This distinction allowed Hwang to avoid many of the reporting requirements that would have revealed the true scale and risk of his operations. Archegos was technically managing only Hwang's personal wealth and that of a small circle of associates, which meant the firm could take massive risks without triggering the alarm bells that would have sounded at a traditional investment fund. The name Archegos itself, derived from the Greek word meaning chief or leader, hinted at Hwang's grandiose ambitions. He positioned himself not just as an investor, but as a visionary who could identify undervalued companies and ride them to spectacular gains. His investment philosophy was heavily influenced by his Christian faith, and he often spoke about using his wealth for charitable purposes, donating hundreds of millions to various causes through his Grace and Mercy Foundation. Hwang's investment strategy at Archegos was deceptively simple, but devastatingly risky. He concentrated his bets on a small number of stocks that he believed were undervalued, then used massive amounts of borrowed money to amplify his positions. His favorite targets were media and technology companies, including ViacomCBS, Discovery Communications, Baidu, Tencent Music, GSX Tekadu, and Farfetch. Rather than diversifying across hundreds of stocks like most institutional investors, Hwang put enormous sums into just a handful of companies, sometimes owning more than 10% of their outstanding shares. To multiply his buying power, he employed a financial instrument called total return swaps, complex derivatives that allowed him to control massive positions without actually owning the underlying stocks. Through these swaps, Archegos could put up just $1 and control $5, $6, or even $10 worth of stock, a level of leverage that would have been impossible to achieve through traditional margin lending. The beauty of this system, from Hwang's perspective, was that the swaps were private contracts between Archegos and its prime brokerage banks, meaning his massive positions remained largely invisible to regulators, competitors, and even the companies whose stocks he was accumulating. The enablers of Hwang's strategy were some of the world's most prestigious investment banks, institutions that should have known better, but were blinded by the enormous fees that Archegos generated. Credit Suisse, Nomura, Morgan Stanley, Goldman Sachs, UBS, and Deutsche Bank all served as prime brokers for Archegos, providing the leverage and executing the trades that made Hwang's strategy possible. Prime brokerage is typically a low-margin business where banks compete fiercely for clients. But Archegos was different because of the sheer volume of trading it generated. The firm was executing billions of dollars in trades every month, generating hundreds of millions in fees for its banking partners. For Credit Suisse in particular, Archegos became one of its most important clients, accounting for a significant portion of the bank's prime brokerage revenue. The relationship was so lucrative that when risk managers at various banks raised concerns about Archegos's concentration and leverage, they were often overruled by senior executives who didn't want to lose such a profitable client. Each bank knew that Archegos was highly leveraged, but none of them knew the full extent of Hwang's positions because he deliberately spread his trading across multiple prime brokers to avoid triggering risk limits at any single institution. For several years, Hwang's strategy worked brilliantly, generating returns that seemed almost too good to be true. From 2013 to 2020, Archegos's assets under management grew from approximately $1 billion to over $10 billion, a remarkable achievement for any investment firm. Hwang's concentrated bets on media and technology stocks paid off handsomely as these companies saw their valuations soar, particularly during the pandemic-driven surge in growth stocks throughout 2020. ViacomCBS, one of his largest holdings, more than doubled in value during 2020, while Chinese education technology stocks like GSX Techedu delivered even more spectacular returns. The success created a dangerous feedback loop. As Hwang's positions increased in value, he could borrow even more money against them to make even larger bets. His prime brokerage banks were happy to accommodate this growth because their fee income grew proportionally, and the rising stock prices seemed to validate the safety of their loans. Industry insiders began to whisper about the mysterious family office that was moving markets with its massive trades, but few understood the true scale of what Hwang had built. At its peak, Archegos controlled positions worth over $100 billion, making it larger than many of the world's biggest hedge funds despite its secretive nature and minimal regulatory oversight. The beginning of the end came in March 2021, when cracks started to appear in Hwang's seemingly invincible strategy. The first warning sign emerged on March 22nd when ViacomCBS announced a massive secondary offering of new shares, diluting existing shareholders and causing the stock to plummet by 9% in a single day. For most investors, this would have been an unfortunate but manageable loss. But for Archegos, which had borrowed heavily to build an enormous position in ViacomCBS, the decline triggered a cascade of problems. As the stock fell, the value of Archegos's collateral declined, causing the firm to receive margin calls from its prime brokerage banks demanding additional cash or securities to back their loans. Simultaneously, other positions in Hwang's concentrated portfolio began to deteriorate as investors grew concerned about the sustainability of high-growth stock valuations. Discovery Communications, another major holding, fell sharply after rumors surfaced about potential regulatory issues affecting media companies. Chinese technology stocks, which had been among Hwang's best performers, suddenly became targets of regulatory crackdowns as Beijing moved to rein in the power of major tech companies. The situation deteriorated rapidly over the following days as Hwang found himself caught in a vicious cycle of declining stock prices and increasing margin calls. On March 25th, ViacomCBS fell another 27% after announcing an even larger secondary offering, wiping out billions more in value from Archegos's position. Other positions continued to decline as algorithms and momentum traders began selling any stock associated with forced liquidation activity. Hwang's banks, which had been competing to lend him money just weeks earlier, suddenly became adversaries as each institution tried to protect itself from losses. The total return swaps that had allowed Archegos to build its massive positions now became instruments of destruction, amplifying losses just as dramatically as they had amplified gains. By the evening of March 25th, it was clear that Archegos could not meet all of its margin calls, and several banks began preparing for the nuclear option, forced liquidation of their positions. The mathematics were brutal and unforgiving. With leverage ratios of 5 or 6 to 1, a 20% decline in the underlying stocks meant that Archegos' equity in those positions was completely wiped out. Friday, March 26, 2021, will be remembered as one of the most chaotic days in modern financial history, as multiple banks simultaneously began liquidating billions of dollars worth of stock positions in what amounted to a controlled demolition of Archegos Capital Management. The day started with frantic phone calls between Archegos and its prime brokers, as Hwang and his team desperately tried to arrange additional financing or negotiate more time to meet their margin calls. But the banks, having finally awakened to the scale of risk they faced, were in no mood to extend further credit to a client who had potentially endangered their own financial stability. Goldman Sachs and Morgan Stanley, perhaps benefiting from more conservative risk management or simply better timing, began liquidating their Archegos positions first, dumping billions of dollars worth of ViacomCBS, Discovery, and other stocks into the market. The selling pressure was immediate and devastating, causing these stocks to crash even further and creating a feedback loop that made the situation worse for banks that hadn't yet liquidated their positions. Credit Suisse and Nomura, whether due to slower decision-making, misplaced loyalty to their client, or simple bad luck, found themselves holding massive positions in rapidly declining stocks. The weekend of March 27 to 28 was spent in damage assessment as banks around the world tried to calculate their losses from the Archegos implosion. The numbers were staggering and would only grow worse as the full scope of the disaster became apparent. Credit Suisse, the bank most exposed to Archegos, faced losses of approximately $5.5 billion, a sum so large that it threatened the institution's capital ratios and forced the resignation of multiple senior executives, including the chief risk officer and the head of investment banking. The loss was particularly devastating because it came just months after Credit Suisse had paid nearly $500 million to settle charges related to another scandal involving Greensill Capital, creating a pattern of risk management failures that horrified regulators and investors. Nomura, the Japanese investment bank, suffered losses of over $2 billion, its worst quarterly loss since the 2008 financial crisis, and a disaster that forced the firm to completely restructure its international operations. Morgan Stanley and Goldman Sachs, despite their earlier liquidations, still faced losses in the hundreds of millions, while UBS and Deutsche Bank managed to escape with relatively minor damage. The Archegos collapse sent shockwaves throughout the global financial system and raised fundamental questions about risk management, regulatory oversight, and the stability of modern capital markets. The fact that a single-family office with fewer than 50 employees could threaten the stability of multiple systemically important banks exposed serious flaws in how the financial system monitors and manages risk. Regulators around the world launched investigations into how Archegos had been able to build such massive positions without triggering any alarm bells, while bank shareholders demanded answers about how their institutions had become so dangerously exposed to a single client. The use of total return swaps to obscure the true size of Archegos' holdings highlighted gaps in financial reporting requirements that allowed massive systemic risks to build up in the shadows of the regulated banking system. Perhaps most troubling was the revelation that none of the prime brokerage banks had a complete picture of Archegos' total leverage, meaning that each institution was making risk decisions based on incomplete information while the aggregate risk to the system grew to dangerous levels. The collapse also demonstrated how quickly modern financial markets could unravel when forced selling met algorithmic trading, creating a cascade of losses that spiraled far beyond what traditional risk models had predicted was possible. In the aftermath, banks around the world began reviewing their prime brokerage operations, implementing stricter risk controls and demanding greater transparency from their largest clients to prevent another Archegos-style disaster from threatening the global financial system.